The new year has started with more good news on the economic recovery, but still with dependence on the vaccine rollout to lead us to the post-pandemic economy. An update on our views as 2021 gets into stride. Much like December, we've seen more economic data locally running ahead of forecasts, as managing the health crisis has enabled businesses to open and consumers to spend. This is in contrast to much of North America and Europe, where, despite the vaccine rollout starting, the COVID-19 case numbers are frighteningly high. But for Australia, effective health policy, combined with aggressive fiscal and monetary policy, has limited the economic damage. The unemployment rate ended 2020 at 6.6%, well down from the mid-year peak of 7.5%, and much lower than the 10% plus rate that many, including our Reserve Bank, had feared. Through 2021, barring any unforeseen problems, we expect the unemployment rate to continue to fall, hopefully back below 6% by year end. Of course, much of this recovery has been driven by government fiscal support, which will be tapering down this year. But labour markets appear to be in great shape, given job vacancies are above pre-pandemic levels, and much of the stimulus thus far has been accrued and not yet spent. As the chart shows, RBA rate cuts, tax cuts and other stimulus measures have driven a rise in disposable income, and the spending of that income is yet to occur. Assuming the vaccine rollout is timely, broadly popular and effective, this should drive a further increase in consumer spending and business confidence from their current elevated levels, as will the commitment from the RBA to keep interest rates low until the unemployment rate is back closer to 5% to drive wages growth higher. Their best guess is this will take 3 years, but these ultra-low interest rates are pushing house prices and stock markets higher, so there's a fine line between supporting the economy and risking an unsustainable surge in asset prices. So rates won't remain down here forever. Our stock market has clawed back almost all the COVID-19 losses that gave us the sharpest and shortest bear market in history, and this has been closely correlated to employment. As the chart shows, when there's jobs growth, there's a rise in risk appetite and share prices. So the promising outlook for jobs this year should feed through to household balance sheets and probably to asset prices too. In the case of house prices, this recovery has also been much sharper than most forecasts from the depths of the recession last autumn. So we start the year in recovery mode, hopeful that further success with health policies will enable fiscal and monetary policy to steer the economy to a strong 2021. The firm Aussie dollar is a sign that this is all on track. But, like stock and house prices, it's best that the rally is slow and steady to allow the economy to rebalance sustainably. And that's the market update from Bendigo Bank.